But if you ask me which one is the over-dominating factor, it has to be supply. We're seeing the U.S. really producing more oil than it's ever produced oil. And we are also seeing that other countries are also ramping up production. So supply is certainly dominating demand. And by the way, when you look at the U.S. economy, 4.2% growth in the second quarter, 3.5%, you're not seeing a lack of demand on the part of the U.S. And even China, now they're ramping up stimulus, monetary policy. They're lowering interest rates. They're also doing more fiscal policy. That's going to mean more future demand.
Because there are a group of people, there's a school of thought, whatever you want to call it, Anthony, you know who they are. They're kind of the bears in waiting, right? And every time we see an economic number that's slightly less than expected, or oil goes down, they say, that's it, we're slowing down, a recession is coming.
Well, I don't think a recession is coming this year. I don't even think a recession is coming next year. But I do think there is a risk of recession, and the risk is significant for 2020.
Okay, beginning at, that's the problem. When I say 2020, it could be January, it could be December.
No,
they're effectively a year apart.
We are looking for the beginning of 2020 as a possibility.
So, okay, well, that's not that far away then. So how do we move? What is Chase recommending? If that's the case, do we start to just wind down certain things?
Well, I think you have to start adjusting the portfolios and moving away from cyclical sectors to more secular type of growth sectors. But one of the things that I did was to look at what happens after midterm elections, even a year later. And of course, you see high rates, more than high single-digit rates of return. And then, because I looked for a recession in 2020, I went all the way back to periods where we had a recession 1 to 2 years after the midterm elections, because after the midterm elections...
How many of those were there?
We have 1958, we have 1978, we have 2006, and guess what, Brian? 8.1% yearly return 12 months later for the S&P 500.
Okay, this is important. I should have led with this. I buried the lead. I'm not good at my job. Here you go. So what you're saying is 3 times in basically ever in America, we had a recession a year or so after the midterm elections. But the next year for the equity markets, we still rose 8%.
8% is the average.
And that's heading into a recession after midterms.
Absolutely.
That's pretty bullish.
Those are the numbers. That's what history tells you.
Why is that?
And by the way, the reason for that is because when you are heading into a presidential election, whether you have a Democrat or Republican, guess what? They like to win elections.
They promise things.
And so they not only promise things, but they start to do things to convince...
Because you get elected by giving people stuff, not taking stuff away.
Well, you get elected by having a healthy economy, and there's nothing wrong with that as an American.
And they'll do it, they'll goose it to keep the economy healthy.
It doesn't matter
correct?
whether you're a Democrat or Republican. Having a good economy is not such a bad thing.
So recession maybe in 2020. History says equity markets could still do well ahead of that. What is your single biggest worry right now, Anthony?
My single biggest worry is the trade situation. But even there, because this is something that Washington has under some control, irrespective of what happened in Congress, I am cautiously optimistic that within the next 3 to 6 months, we may see at least a thawing of those trade tensions.